Hey everyone, if you haven't noticed, it's been 20 days since we uploaded our last video. A lot has gone on since then. The IT side has been kind of a pain in the butt, kind of taking our time, and if you've kind of noticed, I've been sick the last week or so, and it's been terrible, so I apologize.
He decided to come here and infect me too. It's great.
I shouldn't be contagious anymore. I just sound bad, that's all.
It's fine. I'm fine.
So stay tuned till the end of the video, and we have a couple announcements that we want to make concerning the structure of the channel.
Welcome everybody, month 33. It is time to buy a stock and increase our monthly income. We get excited when we do this. However, the circumstances around this month's stock purchase have been very unusual. The economy's direction, everybody's positive, but all the actual numbers that talk about job losses and like the consumer confidence levels, they don't coincide. Consumer confidence is much higher because of the election that just took place. However, people are still losing their jobs. And the Fed has taken notice, and the Fed is deciding, well, if that's going to take place, they're going to potentially lower rates. So when you're taking all of the stuff into account with the Fed, they see the same things that we basically do. So when you're thinking about this with regard to the stock purchase, what does that mean? Well, the stock market is hitting all-time highs again and again and again. It's like constantly doing the things that we wouldn't expect it to be doing in a situation like as we're seeing right now. So basically, all this means is the market this month is really difficult to find something that's good. We went through all of the stocks in our list, every single one. We sorted it by the cost basis to find the ones that were, the most heavily weighted versus the ones that weren't. We sorted it by profitability, and most of the stocks on our profit list are profit list. They are making us money. But most of the stocks on the list are making us a lot of profit. Now, if you buy a company and the company goes up 60%, well, it's not the same. Like if you're buying it for income, you're buying it for investment income. It's not the same value it was as when you bought it before it went up 60%. And almost every stock in our list has done something like that. In fact, last month we bought Merck, and we were thinking the same thing last month because Merck was one of the only ones that hadn't gone up that much. Now it's actually done better since then. Right. One of the things that we also looked at was Warren Buffett's got a indicator. He actually writes about this. Benjamin Graham writes about this, Intelligent Investor. There is a stock market price to GDP ratio. Now, in the book, I'll spare you all the details. Basically, all it says is that anytime that the price of the stock market exceeds the GDP. Now, GDP is like basically every man, woman, and child working. Your dog, your parrot, whatever.
Got a CNI dog, makes money. Got a YouTube channel for it.
Grumpy cat. The grumpy cat probably contributes more to GDP than we do, which is really depressing. Anytime that gets above 200%, you're playing with fire. So that means for every person that's been working in the economy, the stock market is basically twice as expensive. Now, we've been watching this metric creep up for the past couple of years. It was 143% a couple of years ago. It was 158%. Now, I think it was a few months ago, it was about 189 and 191. I posted a link about that and thought, holy crap, this thing is like getting really bad. As of like a week ago, it is now 209%. So when you're looking at buying a stock, what the heck do you do? Everything's overpriced.
Right.
Usually the tech sector trails 15 times earnings. So if they make $1, it's cost $15 for every dollar that they earn. Right now, it's like 35. The historical PE, the trailing PE of the market in itself, is also very overpriced. So in these situations, when the market is doing this, Brian and I decided to play as defensively as we possibly could. Like I said, we looked through everything on our list. We looked at the price of all the stocks, the ones that were making us the most money, tried to find the one that wasn't. Now, do we have a crystal ball? Do we know if the market is going to crash? No,
but if Warren Buffett, the Oracle of Omaha, is selling off stock and is stockpiling $388 billion worth of cash, he knows something, and I want to know what he knows.
It's not just him either. Bank of America has said the same thing. We've heard the same thing from JP Morgan Chase, and we've done this for more than 20 years each. So when you go through that much time, you can kind of pick up on these trends.
Right.
Now, granted, without the crystal ball, we can't for certain say that, yeah, this is going to crash tomorrow. We don't know that. I mean, the Fed could say, hey, I'm going to lower rates by 3 basis points. They won't do that.
No,
but
it's more likely it's going to be a quarter, but you play the odds, you play the percentages to make the best decision.
Right. So the Fed could kick the can down the road a little bit more. Maybe some innovation happens, maybe the economy recovers that way. So with regard to like, do we 100% know for certain, is the market going to tank? Well, we know it's overpriced. We know a lot of the hedge fund managers and the banks are saying, hey, this doesn't look too good. We know there's a lot of layoffs. We know that the cost of inflation is still eating a hole. Yeah, it's still eating a hole in people's pockets. And they just did the report and they said it was a little bit too high last week. Like they came out with that and said it's over 2% still. With that in mind, without the crystal ball, we decided to play the market a little defensively this time. As you know, we like beat up stocks. Also, as you know, we like to buy companies that are
on sale,
that make products that you have to have.
Right.
Like if you look at the portfolio, everything in the list is basically companies that make stuff that people need to use. And if you don't have those things, you either can't live or you're starving to death, because we have food companies in there too. Because the GDP ratio to the stock market price is so high, because of all the other articles that we're reading that we see this, we decided to do two things. First of all, we put half of our investment this month into cash. Why did we do that? Well, we still get an interest on that. There's a 4% interest rate on the cash itself. So it's not a big amount. It was only like $1,500 this month, but that 4% can pay us. Now, if a crash does happen, then we can take that $1,500 and we can invest it in a fat pitch where maybe the prices of the companies go down and we can buy them while they're on sale.
Right.
We're probably going to do that again next month. So we'll build up our cash position a little bit. And we're probably not going to be selling any of the businesses because we are getting now like $186 a month.
Yeah,
why would you not, like, why would you, unless you absolutely had to have the money, why would you give that up? The other thing we did is we looked at the portfolio, as I said above, and we decided that based on everything that's happening, in bad economies, companies like Campbell Soup tend to do pretty well. People stop going out to eat. They stop buying expensive, like, stuff.
Yeah, and if there is the looming recession or economic collapse or war or whatever is going to happen, people tend to stock up on food stash, like canned foods and toilet paper and stuff like that. So we're betting on the fact that that is going to happen soon, and there will be a good buy for Campbell's.
Now, the other thing to mention is, yes, we know Campbell Soup is still restructuring. Yes, we know they're not the best performer in our portfolio, but their dividend's relatively healthy, and we think that they've got some pretty good numbers. Like they beat their earnings, the acquisition they made that's starting to show up in their balance sheets.
Yep, Sovos.
Yep, we went through their earnings report. We saw all the things that looked good, and we can post that as a link down below, or even just scroll it across the screen so you can see some of those same metrics that we were looking at. And based on our portfolio, now this is not your portfolio, so if you got an advisor, work with them, vet it with them. But with our portfolio, this one at the time seems like a good bet.
And it was one of the lowest positions we had in our portfolio. So It was a good time to bring that up to everything else.
Yeah, we want to try to average out the portfolio. That's that cost basis that I mentioned earlier. You don't want to be too heavily weighted in one sector or another. So we tried to leverage that out and make Campbell Soup more of a player in the actual portfolio. So we think long-term it's a good buy. We think it's a pretty safe bet if the market crashes. If you're worried about, if you've been following along and you've been investing, you're worried about the market actually crashing, well, typically the markets will crash around 40%. Some sectors will get hit harder than others, but over the next preceding 10 years, the market tends to grow at about 500% after that. So not looking to sell, looking to capitalize on that. So that's why we're still buying some stocks, but we're buying less than we normally would, and we're piling up some cash to wait for a fat pitch.
Right. So when the recession does happen or a slowdown does happen, look at our portfolio and watch it. And you'll see it not go as low as the S&P or other portfolios that are on YouTube.
Talking to you, all you Magnificent Seven holders.
And that's why we invest the way we do, defensively.
We like those companies, but they overpriced.
Onto the channel changes. As you've noticed, we haven't posted a video in a while. There's been a lot going on with the IT side of our company, and
it's been nuts.
It's been taking a lot of our time. So what we're going to try and do is every Monday at noon or 1 or 2, whichever time we actually can get to it.
They're going to time me down.
We're going to try and make it the same time every Monday, do a live stream. So that way we're there. You can tune in at that time. You know when it's going to be. You can ask us questions. We're going to go over some portfolio decisions that we're making at that time, looking at some stocks, doing some evaluations, analysis. Who names? You name it. And who knows what's going to morph into, but that's the idea. You're probably going to also see less of Tom in some of the videos for a short time because he's dealing with administrative stuff and CEO stuff. So you'll have to settle for me for a little while until we can get this channel going and gets monetized, get some money going, and that way we can pull in some more support.
Now, I'm still doing the research where I'm still going to do the monthly stock purchase. We'll still do the live stream where we can talk about the whatever stocks look good for this potential month purchase. But you know, when you run a small business, it's a lot like herding cats, especially hungry cats that have not been spayed or neutered or declawed.
When have you fed me lately?
IT is a very interesting field. That's a whole different discussion, but I need to stay focused on that for a bit. Like I said, the stock purchases are not going to go away. I feed a lot of the benefits in our company through dividends themselves, so I need to keep that going, so I need to stay up on that. So that's not going to go away. Just a lot of the work that goes into this will die down until if or when the channel actually decides to pay us for all this work. Hopefully it's helpful to you if it doesn't pay us.
So tune in Mondays, and I hope you enjoy the stream, and hopefully you have a very Merry Christmas.
Yes, Merry Christmas. Thank you for following along, everybody.
Peace.